Okay, I think we will we'll make a start. I think most of you who are going to attend are probably here now. So good afternoon, everyone, and thank you very much for joining our budget webinar. Many of you will probably know us already. I know quite a few of you are clients, but not everyone will know us quite so well. So for those of you that don't, we are the leading accountants and advisors to the media industry, working with clients right across marketing services, film, TV, theatre and media tech sectors. We're part of Kingston Smith, which is a top 50 accountancy firm, and we sort of specialise in all these sort of media clients from our West End office, where we've got 90 professionals usually sitting in our West End office off of Tottenham Court Road. Obviously at the minute everyone's sitting at home instead, and we work with hundreds of clients ranging right in size, from sort of startups right through to sort of multinational PE-backed groups or some AIM-listed companies. So it really is a broad spectrum of clients that we work with, and it's the activity of the client that makes them special to us rather than necessarily their size. We're also part of an international network called More Global, with presence in over 100 different countries, and obviously that makes us very well positioned to advise our clients when they're looking to go international, which increasingly is very common amongst many of our clients, particularly going to the US, and that allows us to sort of give them a very joined up service being part of that network. So today we're going to be talking through what happened on Wednesday and what Rishi has in store for us. So I'm delighted to introduce Mike Hayes, one of our tax partners at Kingston Smith. He works very closely with all of the partners in our West End office and works very closely therefore with a lot of our media clients. So Mike advises on all things tax really, but particularly does a lot of work in employee incentives, group restructuring, supporting on M&A transactions and due diligence, and recently actually advising on quite a lot of sales to EOTs, which is becoming a very popular alternative to trade sales, and also spends a bit of time in the US as well, making sure that we're able to give very joined up tax advice from the UK and across the pond. So there will be some time, Michael's got some slides, there'll be some time for questions at the end, but actually what we're going to do is pause for thought along the way throughout the presentation. So please do put questions into the Q&A function. Please put them in the Q&A function, not the chat function. It's much easier to manage them in the Q&A function. And I will put those questions to Mike as we go through our presentation. Brilliant. Right, so we've got 80 people, so hopefully that's everyone that's here, so no one will miss anything. And I will hand over to you, Mike.
Okay, thank you, Esther. Good afternoon, everyone. Welcome to this webinar. Just bear with me whilst I share the screen, which will take a moment or two. And hopefully not too long. Okay, so Wednesday was the budget, as you're aware, and I've been doing these budget presentations now since, I don't know, the 1980s, so a long time, longer than I care to remember. And I've never known any budget in the past stir up so much advice given to the Chancellor in advance of the budget about what to do with taxes, what new taxes not to introduce, not to increase tax rates, all sorts of things. And I just hope that he actually had a bit of common sense and didn't listen to all that, because most of the advice was largely conflicted or conflicting each other. So Rishi stood up on 12:30 p.m. on Wednesday, and his sort of what he was saying a lot of the time throughout his talk was, I'll do whatever it takes. So let's have an examination to see if he has done whatever it takes. So these are the topics I want to go through. Most of what I'm going to talk about is on corporate and business taxes, because I think that section has the most fundamental changes. But I will go through one or two other things, and I'll also comment on one or two things I ought to remind you of towards the end, and also talk about anticipated changes that didn't happen and comment on those. So let's make a start with corporate and business taxes. So unsurprisingly, because it was fairly heavily trailed, we've now got an increased rate of corporation tax from the 1st of April 2023. And as trailed, I think it was expected that we would announce an increase and that it wouldn't come into effect immediately, because clearly he's trying not to inhibit any recovery once we come out of this pandemic. So we're going back now to a two-tier system of corporation tax, where you will pay 19% on your company's profits, on profits of up to £50,000. If they're over £250,000, your profits, you'll pay 25% on the whole lot of your profits. And if you're in between those two bands, 50 and £250,000, there is in fact a marginal rate of 26.5% if you fall between those two levels. So that's something that you need to bear in mind, and whatever you can do to keep out of that band between 50 and 250,000 might be worth doing. For those of you who remember when we had a two-tier system before, when we have limits on profits which affect the rate of tax, those limits are divided by the number of companies under common control. So, for example, if there's 4 companies in a group, that 50,000 limit is divided by 4. Likewise, the 250,000 limit, but it's not just a group. It's any companies under common control that the limit is divided by, which can push you into a higher rate of tax than perhaps you're expecting.
Oh,
so
Mike,
that's probably,
Mike, can I just pause you a moment? I thought maybe my computer had frozen. Your slides, I mean, you are frozen on my screen. Maybe you're not on everyone else's, but your slides aren't moving along. We can hear you, but the slideshow isn't moving.
all right.
So I've had a couple of people comment, and I thought it was just me actually, because my internet can lag a little bit sometimes.
Goodness.
Have you pressed slideshow view show? I'm assuming you have.
I'll actually, I mean, yes, they're moving on my screen. I've just.
So you're not moving either. You're frozen.
No, well, I can't understand why that is, but
you're moving now.
am I?
Yeah, try again maybe. If not, I can try share them for you if you email them to me.
Okay, they are moving on my screen, so there you go. Let's go back into it then. Bear with me. I apologise for that.
No, my shot. I should have picked it up, but I thought it was just me.
Right. Now I need to find my slides actually. Where have they gone? Sorry. Now the technology worked perfectly this morning. That's what I think. Okay. Can you see those?
No.
They're up on the screen now. They should be.
No. I can't. I can see a red header. Can anyone else see them? Apologies for this. It's very unusual that we have a technical hitch, to be honest. A couple of people just let me know if they can see them, but I can't. Just a red header. Yeah, no one can see them. Shall I attempt? Not that I'm great at tech either, Mike, but shall I see if I can attempt to share them? I don't know why yours wouldn't be working. Maybe we don't know, but
well, it worked perfectly this morning.
Yeah,
what I will do is I'll try coming out of Zoom and going back in, and then see if that actually helps.
Okay.
I'll try again then. Can you see those now?
Yeah, I can, but I can also see the smaller bits along the left-hand side, but it's not showing as a slideshow, but I can see them.
All right. Okay. Well,
it's too much.
Okay.
It's just not full screen, so you just need to go into slideshow, view show.
Okay, so where did I get to then?
We're sort of nearly finishing corporation tax, I think.
Yeah. So those are the two rates of tax. Apologies for that. So hopefully everyone's taken that on board, and that's from the 1st of April next year, and slightly complicated if your profit's hovering around 50 to 250,000 pounds. If you're a close investment holding company, you will always pay tax at 25%, the higher rate. And basically, a close investment holding company is one that's either isn't carrying on a trade or isn't is holding land and buildings that isn't being let commercially to third parties. So if you have an investment company where you let properties to connected people, or if you're otherwise an investment company, your rate of corporation tax is 25%. The rate change.
Mike, shall we pause there for some questions, because the slides still aren't moving along. I don't know what's happening, and maybe if people have got questions, ask them, and then Mike can answer them while I try to share instead, because I don't know why, but it's just not moving along. So if you stop sharing, and I will attempt to share myself.
So I've got some questions and answers. I'll try and pick up those then, whilst Esther's.
Yeah. You need to stop sharing, Mike. Have you done that? Yeah, okay.
Okay. Can I talk through the marginal rate again? Well, yes, I can. So the reason why you have a marginal rate is that, as I explained, your profits are taxed at 19% if your profits are £50,000 or less. If your profits are £250,000 or more, you're taxed at 25%. And the whole lot is taxed at 25%. So you don't get the first 50,000 at 19%. So because of that, to get from the lowest step, if you like, of 19% up to the higher step of 25%, you actually have to apply a higher rate of tax, which in this case, the marginal rate is 26.5%. And that's what you actually get to get up to that rate of tax. So I hope that explains the marginal rate. If you go back a few years when we had two rates of tax, that's always been the case, and so forth. And I had another person ask the same question about the same thing. So I hope that actually explains it. Fortunately, the 26.5% is not that much higher. I mean, in days gone by, the marginal rate could have been quite penal.
Okay.
Are you showing on the screen now? So I can move.
I think I'm. Can you see a screen share from me?
Yeah, I can do. Right.
So yeah.
So let's pick up and go forward. The answer to this is I should do these on Friday mornings and not on Friday afternoons. But anyway, so one of the things about a change in corporation tax rate is it does affect the overall tax liability if you want to take some money out of your company by way of either bonus or dividend. And on this table, I've actually got in the left-hand column the position with the tax rates as they are today for both a 40% payer and a 45% payer. And as you can see from the effective rates, there is a saving in actually paying tax, paying yourself a dividend as compared to a salary or bonus. And that saving in terms of overall rate of tax is just over 3.5%, as you can see. One of the things that's happened, of course, is with an increase in corporation tax, that balance has changed a little. And as you can see from the two right-hand columns in 23, 24, there's very little difference between the two. And the reason for that is obvious, but I think is obvious anyway, is of course that the bonus is a deduction from profits for corporation tax purposes, whereas a dividend is paid after corporation tax has been paid. So if you like, the higher the corporation tax rate, the more attractive the bonus route is. So you might want to bear that in mind. What I would say is if you fall in the marginal band, which I've been talking about, it is definitely better to pay yourself a bonus rather than pay a dividend, because clearly you're saving tax at 26.5% at that point. One of the things somebody has pointed out to me, that if you're looking at paying money out, is of course that paying bonuses does affect gender pay gap reporting, whereas dividends don't, because they're not counted. But I'll leave that from there. Let's see if I can move this on. I can. Right, so the other big change, apart from corporation tax relief, is the way in which you can utilize losses. So most businesses, or a lot of businesses, not fair, not most, quite a few businesses have generated tax losses during the pandemic, and you need to be able to utilize those. Now, one of the ways you can utilize a tax loss is you can carry it back against the profits of the previous 12 months. But that's now been extended. And firstly, I'll talk about companies, then I'll talk about partnerships and sole traders in a minute. So for companies, for any accounting period that ends between the 1st of April last year and the 31st of March next year, you can actually carry back the loss now for 3 years. So for example, if you make your accounts up for a calendar year, this will apply for the 2020 calendar year and the 2021 calendar year. And as I say, if you made a loss in either or both of those years, you can carry them back, and you carry them back and set them against profits of a later year rather than a previous year. So if we've got a loss in 2020, we have to set it first against profits in 19, then 18, then 17. So that's quite a generous sort of relaxation, I think. Now, there is a limit on the amount of loss that you can carry back, and it's 2 million per year of loss. So the maximum you can ever carry back if you've got losses this big is £4 million. And if you have got £4 million of losses or more, this is going to equate to a £760,000 tax saving immediately if your tax rate is 19%. I should add that that limit applies on a group basis. So the 4 million or the 2 million per year does apply to a group of companies, and you would have to share it around the group in a way which I suspect will get specified in the legislation. You do have a choice now, of course, if you are in this position where you could carry back a loss, and that is, do you actually carry it back and actually save tax at 90%, or do you leave it and carry it forward and potentially save tax at 25% in a couple of years' time with the corporation tax rate that goes up? Well, two comments on that. One is I was brought up always to use tax reliefs sooner rather than later. And when I started my career, the main rate of corporation tax was 52%. So that probably explains why. And also cash flow might dictate that you actually need the tax back before you can wait to actually get a tax saving in a couple of years' time. But there is a sort of decision point at that. Moving on, right. For unincorporated businesses, there's a similar change. So for a loss in either the tax year 2021 or 21-22, or both, you can again carry that loss back for 3 years. You start with later years before earlier years, as with companies. Again, there's a 2 million cap per year of loss, but that cap applies to individual taxpayers. So if we're looking at an LLP, for example, or a partnership with 10 members, each member has that 2 million per annum cap. If you're carrying back losses for the 3-year period, you can in principle set them against not only the profits of your business, but also other income that you may have. So for example, if you've got an investment portfolio or let's say a rental income portfolio, you can carry those back. However, if you want to set the loss against income other than profits from the same trade, there is a limit in which you can actually set that off. And that limit is £50,000 or 25% of adjusted total income, whichever is the higher. So although you can carry back your loss for 3 years, if you're setting it against anything other than your profits from your trade, there is this limitation which you have to factor into account, which just makes the calculation a bit more fiddly, but it mustn't be forgotten. And then the third major change on business tax was really floating around sort of capital allowances. So as far as capital allowances are concerned, I've put up some of the major rates as they are today. So for most plant and machinery, you get an 18% writing down allowance. For certain items, you get what's called the special rate, which is 6%, and that applies to integral features, long life assets, and cars with CO2 emissions over 110 grams per kilometre. I should actually say that cars with CO2 emissions of 50 kilograms per kilometre or more actually fall into the 6% rate and taken out of the 18% rate for next year. So it's a little bit less attractive for low emissions cars. Integral features are things that you have fixed in a building, and they're the only things you can actually get them on. And these slides will be sent to you later, so you better look at that list, but that's the only thing you can get integral features allowance on. And then, of course, you've got the annual investment allowance. Now, at the moment, we have an annual investment allowance of £1 million, which was due to come to an end on the 31st of January 2020. But sorry, 31st of December 2020, but this has now been extended for another year. So you've got this 100% annual investment allowance of £1 million for another 12 months up to the end of this calendar year. And then there's a 3% buildings and structures allowance, which I won't dwell on anymore because this is not affected by the budget changes. So there are, in fact, two changes that come into play as announced by the Chancellor on Wednesday. And firstly, there's the super deduction. It applies to companies only, and it applies to plant and machinery that would otherwise qualify for the 18% writing down allowance. And basically what it means is if you incur expenditure on that type of plant and machinery in the 2-year period starting 1st of April this year, then you can claim this enhanced allowance. Now, before I go on any further, there are some complicated rules about the time at which capital expenditure is deemed to be incurred, and it's not necessarily the day you pay for it or the date it's on the invoice. So there are some rules around that. So if you're at the beginning or the end of this 2-year period, you might want to come to talk to us about it. It must
Mike,
be
can
new.
you hear me?
Yeah.
Somebody's asked, could you just explain what you mean by plant and machinery? Because I mean, that's quite a broad brush definition, isn't it? And it sounds a bit like things you'd find in a factory, but that's not really the case, is it?
No. Plant and machinery is right. So yes, it could be planting in a factory. It could be desks, chairs, computer equipment. It could be vans, not cars in this situation. Yeah, although it can be cars, but not for the purposes of this relief. So it can be anything that you would actually regard as movable plants and equipment, or in some cases fixed plants and equipment if you talk about large plant in a factory. So it will include things that are in offices, and particularly, of course, IT equipment, which is likely to be the most expensive thing that many of our clients will actually have. So it includes that. Okay, so moving on, it must be new, so not unused and not secondhand, so you can't go and buy it off a sister company just to get this extra relief. That won't be permitted. It doesn't apply to cars or plant and machinery for leasing and one or two other things. And the basis of this super deduction is that you get a 130% first year allowance. So you get an extra deduction over and above the cost of this particular asset that you bought. One of the consequences of that is that there is also an adjustment when you actually sell the asset. So if you sell the asset, you normally bring in the proceeds from the sale as a balancing adjustment in working out capital allowances in the future. If you sell one of these assets on which you've claimed 130% first year allowance, then the sale value that you bring in, you multiply by 1.3. So you have the 1.3 multiple at the beginning and at the end. Obviously, if it's an asset you simply scrap because once you've finished with it, it's no good, it has no value, then of course there's no sales price, so that has no effect.
Mike, you've mentioned the obviously the 130%, you know, that you've got the super deduction and then you've got your normal annual investment allowance. But somebody's asked, how does the super deduction sort of interact with the annual investment allowance? what sort of extra benefit are we getting if we would have already got the annual investment allowance?
Well, if my next slide actually illustrates the point.
There we go.
All right. So, I've got two sort of very simplistic examples here. So, if a business spends 100,000 on plant and machinery, at the moment, the annual investment allowance, they'd write that £100,000 off for tax. It would actually save them £19,000 in year one. With the new first year allowance, instead of writing off £100,000, you actually write off £100,000 times 1.3, and at 19%, that gives you a saving of 24,700. So the difference between the two, if you're within the sort of annual investment allowance band, is only about £5,700. So it's not that great. Where I think this is going to benefit is larger companies, particularly those companies that are already going to spend more than their annual investment allowance limit. And just to move on and just illustrate that. So if you take a company which has already spent more than £1 million, so it's over its AIA limit, it spends another £1 million on capital expenditure, then the writing down allowance you'd get in year one would only be 18% because you've gone over your annual investment allowance. And at 19%, that gives you a £30,000 tax benefit in year one. With the new first year allowance, it's £1 million times 1.3 at 19%, which gives you a £247,000 benefit in year one. So as you can see in that situation, it is actually much more attractive. I suspect the rationale behind this is to actually make it attractive for larger companies to invest, particularly in manufacturing, which are, have a heavy spend on plant and equipment, it to give them an extra incentive and actually to invest in new plant or to invest in new activities where new plant is required, because the tax break in year one is so much larger. I think that deals with the question, Esther. So
I think it does.
I'm going to move on to the second change. And this, again, only applies to companies. And this is an enhanced first year allowance. It applies to plant and machinery that would qualify for the 6% writing down allowance. So for most people, this is going to be integral features in a building, things fixed into a building. Again, it's expenditure within the same 2-year period. But what happens in this case is you get a 50% first year allowance instead of a 6% writing down allowance. It doesn't apply to cars, etc., rather like the previous one. And what it means is that basically, and I think this will apply to large buildings, well, any buildings really, where you spend money on integral features, you'll be able to get right off 50% as a first year allowance. Now, there has been adverse comment, I think. Margaret Hodge, I think, being one of the people saying this is just a bung to Amazon, because Amazon build big sheds and have lots of sort of fixtures fixed to the walls and the ceilings and the roofs and etc. And they're going to get a lot more of a write-off. I'm sure that probably wasn't the motive of the Chancellor. Amazon and tax integrity don't actually sit very well in the same sentence, but it will certainly favour businesses that are building, let's say, large workshops with lots of integral features. Okay, moving on from the capital allowances, the self-employed income support scheme, which applies to those who have suffered from COVID. If you're self-employed, that's being extended. It will now include those who are new to self-employment from 2019-20, which is good. And there are going to be 2 new grants. There's a 4th grant, which is coming out now, which will apply up to April, from February to April this year. And basically, rather like the previous grants, you get 80% of 3 months average profits with an overall cap of £7,500. And then there's going to be a 5th grant that will kick in from May through to September. The amount of the grant here will actually depend upon the amount by which your turnover has fallen as a result of the virus. So If your turnover has fallen by 30% or more, then you'll get an 80% grant, rather like you can do now with a similar cap. If your turnover has fallen by less than 30%, you will actually have only a 30% grant. I haven't spotted how you measure the fall in turnover by reference to which periods, but there you go. So if you're self-employed, you might want to take a look at that. There is a new loan scheme to enable businesses or help them recover from the lockdown. This is called the Recovery Loan Scheme. It will be open from the 6th of April through to the end of the calendar year. And basically, this is where the government is going to guarantee 80% of the finance offered, and it'll be guarantee provided to the lender. And he went through a number of banks that have already signed up, and he implied that more banks would be signing up. Excuse me. So in terms of overdrafts and bank loans, term loans, it'll apply for facilities between 25,000 and 10 million. For invoice and asset finance, it applies to facilities of between 1,000 and 10 million. The facilities have to be no more than 6 years for term loans and asset finance facilities, and up to 3 years for overdrafts and invoice financing. If you take a small loan, that is no more than £250,000, there mustn't be any personal guarantees. But if your loan is above that, the bank can ask, or should I say the bank will ask, because I don't suppose they're not going to ask for personal guarantees, but they can not actually insist on your main residence being subject to that any security. So that will be left out of account. Moving through, there's a few more conditions. So it must be a company that's trading in the UK, not necessarily just a UK company. It could be a foreign company trading in the UK, and you need to demonstrate that the business is viable, or would be if it weren't for the pandemic, that it's been impacted by the pandemic, and you're not in any sort of insolvency arrangements. And there's some more conditions. So if that's of interest, you'll need to actually go and look at the detail in a bit more. But that could be a value for businesses looking for funding to help get out of the slowdown. For R&D, just two things to say in research and development tax credits. When research and development tax credits were first introduced, the amount you could have as a repayable credit was limited to the amount of PAYE that the company had actually paid. That limitation was removed some years ago, but I think the Treasury has become concerned that there are quite a few spurious claims coming in from SME businesses, or probably from certain advisors, should I say, and that seem out of kilter with the size of the business concerned. So they're reintroducing a cap, and in the future, the repayable credit is actually going to be limited to £20,000 plus 3 times the client's PAYE and NIC liability. So not quite as stringent as before, but there will be a limit on that. And that can be particularly difficult, I think, where your R&D is not actually necessarily undertaken by employees, but you have freelancers, which is a whole other set of problems which I'll mention later. Because clearly with freelancers, you won't have a whole lot of PAYE and NIC. And there's some exceptions to that. There's also going to be some consultation. It's called a call for evidence about R&D relief generally. And basically what they're looking at is, are the reliefs competitive compared internationally? Are they targeting the right areas? And they're also looking at the scope of qualifying expenditure. So at the moment, things like money spent on cloud computing and data sets doesn't qualify for R&D. And there has been speculation that it will be extended to include those types of expenses. So if you're interested in making representations on that, there is a document that you can refer to on the HMRC website.
And obviously we have a great deal of in-house expertise as well on advising on R&D tax credits. We've got a team that Mike works closely with, so well equipped to help you with that. Mike, there's a question coming about, just sort of rewinding a little bit back to the recovery loan. Somebody's asked, can you apply for a recovery loan if you already have one of the sort of the bounce back or the CBILS loans? Now, I think the answer to that is yes, isn't it?
Yeah, I haven't seen anywhere that says you can't,
No.
and I think it would say if you can't. So I would presume that the answer is yes.
Yeah, I'm pretty sure the answer is yes.
Yeah, I think the answer is yes.
I mean, and also we've got a number of a couple of clients who've taken out ordinary term loans during this period, and the banks are actually now suggesting to them to convert those into CBILS loans. So maybe they'll now be suggesting they turn them into recovery loans. I don't know, but we'll see.
Okay. Right, withholding taxes, which is important for a lot of our clients, particularly those who license software or other creative works around the world or lend money across borders. Whilst we're in the European Union, and during the transitional period for that matter, we were subject to what was called the EU Interest and Royalties Directive, which basically provided that if you were paying or receiving royalties or interest from another company wherever in the EU, there would be no withholding taxes. And we incorporated those rules into UK tax law. But I think somebody's realised that post the end of at the end of the transitional period, the rest of the EU has disapplied the Interest and Royalties Directive for payments made to UK companies, but we've failed to make the appropriate amendment to our legislation. So those rules are going to be deleted from our legislation with effect from the 1st of June. I could make some comments about the way they treat us compared to the way they treat them, but perhaps I won't. But anyway, what it does mean is that if you're making payments of royalties or interest to another company within the European Union, then you need to be looking at whether you actually have to deduct withholding taxes after the 1st of June. It actually relates to the date the payments are made. So that would mean looking at the relevant tax treaty, or we can help you with that. But it will also mean looking at the relevant agreement under which you pay the interest and the royalties, because sometimes they provide for no withholdings, or for the fact that you actually have to gross up the payment for the tax so that they receive the same net anyway. So there's some work to do there. And likewise, if you're licensing out something, some IP to another European country, you've got to look at it from the other side coming to you, because you might start to find that you're having 20 or 30% docked from the payment, and maybe it could be less under the treaty. So that is quite an important issue for businesses going forward. I mentioned free ports, but very briefly, there's a whole range of reliefs, tax reliefs announced for free ports. I won't actually go through that in any particular way, just to draw your attention to it. And the free ports in England, those are the destinations that have been chosen for England, and they're going to be other ones chosen for Scotland. I think they've announced some of them for Wales. So if you're interested in relocating to a free port, there you go. One of the things we do a lot of for clients, particularly in the sort of media sector, is share incentives, and the most popular scheme is the Enterprise Management Incentive, EMI. And there's been a call for evidence, basically to sort of look at whether or not it's doing what it should do. And basically the questions that are being asked are, should it be extended to cover more companies, or are the limits that the scheme actually applies prohibitive? Now, one of the limits that we find a problem quite often is there's a maximum number of employees that you can have at the date of grant of 250 employees. And if you're a fast growing company, you know, you could easily rocket through that at a fairly early stage. And EMI, which is the best share scheme available, no longer applies. Now, you still may have the same need to recruit good staff and retain good staff, and maybe your share options are a way of actually helping you do that. So it seems to me to be slightly irrational to have a low limit on this, which 250 is not many employees at all. So hopefully that will get increased. One of the problems with COVID is it potentially could have given rise to problems with EMI because you have a working time requirement where you're supposed to work full time, which is being required to work at least 25 hours a week on average. Clearly, if you're furloughed or you had to reduce your working hours or you took unpaid leave, you could easily fail to meet that requirement, which normally would mean that your EMI options would cease to be valid. Well, they announced back last year that they were going to change that and actually have an exception where you've worked reduced hours because of the coronavirus or you're furloughed, etc. They've now sort of put that in, or will be putting that in the finance bill, and that that sort of exception will apply through to April next year, which hopefully we're long out of this mess by then. Very small point, social investment tax relief. Now, this is a relief designed to encourage people to invest in social enterprises, such as charities and community interest companies and the like. And the way it was structured was made it very similar to enterprise investment scheme. So investors would actually get income tax relief on the amount they invest and potentially a capital gains tax exemption if they realise that investment is a profit. That was due to come to an end this April. That's been extended for another 2 years. And I imagine the reason that's been done, I mean, well, the feedback on is there was not much take up on social investment tax relief, but I suspect, like many other businesses, some of these charitable and community interest companies have suffered from fundraising, poor fundraising during the pandemic. So I presume it's been extended just to sort of help encourage people to put more money in at this stage. And OECD reporting. Well, this is just a warning for the future. Under the OECD, there are going to be arrangements for local tax authorities to obtain information from digital platforms and then exchange it with overseas tax authorities. So for some time after January 2023, certain UK digital platforms will have to report to HMRC about the income of businesses and individuals that you sell using that platform. And when they've got that information, they will swap it with other tax jurisdictions and vice versa. So if anyone is selling on those things and not properly reporting their income, they will actually find themselves uncovered in the not too distant future. I will mention as a little bit about the sports and culture sector. There's quite a few things that have been introduced to help the sector. And I will just mention them briefly. You perhaps need to go to the specific sources. So the first one's the Cultural Recovery Fund, which has been administered by the Arts Council. And then an extra 300 million has been added to the Cultural Recovery Fund to support cultural organisations in England. There's an additional £90 million for national museums, and there is an extension of the 500 million film and TV production restart scheme. That's been extended up to the 31st of December, which is another 6 months. So some of those might be relevant to people in this sector. If it applies to you, then you need to go and dig into the relevant details and ask. That's the end of the business tax situation. Esther, are there any more questions at this stage before I go to personal tax?
No more questions. I'll pick them up as we go, so I would push on. All
right. Okay. Right, personal taxes. Not too much to say on this. The first thing is that our personal allowances are being indexed for next year. So it'll go from 12,500 to 12,570. The level at which you actually pay tax at 40% will go from 50,000 to 50,270. And it's going to be those figures in the right-hand column in blue there. Then all those rates and bands are going to be frozen to the end of this Parliament, which is up to and including the year 25-26. I think I read somewhere this morning that somebody expected that this would bring an extra 1.3 million people within income tax or not in income tax at the moment. I'm not sure that's the right number, but it will have that effect. So your allowances are going to be frozen from 21-22 onwards. Lots of things didn't change in the budget. So ISA limits, inheritance tax rates, nil band, capital gains tax rates, capital gains tax exemptions. Nothing's changed on those. They all remain the same. And the other thing that's frozen is the pension lifetime allowance. It's going to be frozen at £1,073,100, and again till April 2026. So if you're like me and you'll be retiring before then, that's probably not such good news, but there you go. Let's not make this too personal. Stamp duty land tax, as everyone was aware, if you were looking to sell a residential property, then to keep the market buoyant and to encourage new builds, the nil band, which was £125,000, was increased to £500,000 as a result of the pandemic. That was due to end at the end of this month. It's now been extended for another 3 months. And rather than actually falling back to £125,000 and having a real cliff edge on the 30th of June, there's going to be an interim nil band of £250,000 that will apply for July through to September. And then after September, it will go back to the original £125,000. So it'll come down in 2 stages, which probably makes it less of a dramatic change. There's no doubt when we get towards the end of June, people will be asking for their £500,000 to be extended. So with £500,000 as a nil band for acquiring residential property, those are the current stamp duty land tax rates, which when you get the slides, you can actually have a look at them. That's how it works.
Mike, we've had a question about what's happened to dividend allowances.
What do you mean savings allowances? The savings limit,
well, there was that the £2,000 limit that we used to have.
Yeah,
on dividends,
I think they've all stayed the same.
Right. Okay.
They've not none of those have changed at all.
And the tax rates on dividends have stayed the same as well. Yeah.
Yeah, that's right.
Yeah.
Yeah, that's changed. And so on to employment taxes. Firstly, the coronavirus job retention scheme, that was due to end on the 30th of April. It's been extended for another 5 months. Employees will continue to receive 80% of their salary for hours not worked, but employers, as before, will pay NIC and pension contributions on the amounts the employees receive. There is a slight change, is that the employers in the future will be required to contribute towards the cost of unworked hours. And in July 21, that contribution will be 10% they'll need to make. And in August and September, it will be 20%. So if you have been furloughing employees and you look to continue that process, then of course, slightly different rules, but at least it's been extended, but you might need to make a bigger contribution. And of course, if you are furloughing people, don't forget that the name of your business will actually be published on HMRC website. I don't think it's really there to name and shame you, although I think some businesses have taken the view that it's bad PR, but what it's designed to do is actually make everyone aware that you are. And if you're actually asking people to work when they should be furloughed, it's designed as a way of sort of potentially rooting out any fraud in respect to this. So just bear that in mind. There are reliefs that have been given for reimbursing or employer providing coronavirus antigen tests. They're going to continue to April 22. Likewise, reimbursing employees for home office costs. Those reliefs are going to continue through to April next year as well, which is useful. Okay, VAT.
Oh, we've got a couple of questions. We've got a couple of questions, Mike. Somebody's asked, what about entrepreneurs relief? Any changes to that in capital gains tax?
No, I'm coming on to capital gains tax in a minute.
Perfect.
So I'll answer that one in due course if you don't mind.
And somebody's asked about on income tax bands, has the child benefit higher earner charge also gone up to 50,270?
To be honest, I don't know.
I'm assuming it will have done, but we can come back.
Yes, I actually don't know. When you get these slides, my email address is at the end. So if you want to email me a question offline, then I'll happily come back and have a look. But I can't remember seeing that one way or the other. Okay. Right, VAT. There was a reduction in VAT for the hospitality sector and the tourist sector to 5%, and that was due to come to an end in March. That's now going to continue throughout the summer until September 2021. I mean, I've heard on the news today that prices for bed and breakfast and hotels and self-catering accommodation in the UK have rocketed because people are actually looking to stay in the UK rather than go abroad. So maybe this incentive is not that necessary, but it's going to continue through at 5% till 30th September. And then for the next 6 months up to March next year, there'll be a 12.5% rate on the provision of those sorts of facilities. And then from April, it will go back up to 20%. Which it was before the pandemic. You may be a business which chose to defer its VAT payments that were due between the 20th of March and the 30th of June last year, and you were able to defer those payments until the 31st of March this year, in other words, the end of this month. Well, there's now going to be a further deferral scheme allowing you to spread that payment over 11 equal amounts rather than make it in one payment on the 31st of March. However, and that was pre-announced. However, what we now know, because it was announced on budget day, is that if you sit there having deferred your VAT from last year and you do nothing, you don't pay it on the 31st of March and you don't enter into a further deferral scheme, you will be charged a 5% penalty. Whatever happens, if you can't pay the VAT you deferred on the 31st of March, you must engage with HMRC and apply for the further deferral scheme. Otherwise, you'll just get an extra 5% on top, which doesn't make for being happy, shall we say. And finally, on VAT, the VAT registration threshold and deregistration threshold, they're going to be frozen for 2 years from April, and those are the particular levels. Moving on, some reminders. And this has got nothing to do with the budget, but just to remind you all that, of course, the off-payroll working regime is coming into effect for private companies from the 6th of April this year. It was deferred 12 months from April 20, when it should have come into April 21. And there was a campaign to actually get it deferred another year. And unsurprisingly, that didn't find favour. So now, if you engage people who provide their services through personal service companies, you ought to have actually started this process, but it's not too late. And that is, you need to determine whether the contracts with these companies are within IR35. And that means reviewing those contracts and perhaps putting the details of those contracts through the HMRC checker called CEST, C-E-S-T. Whatever you determine, whether you think the worker and their service company is employed, one of employment or one of self-employment, you are required as a matter of law to notify the worker of their status. And if the worker does not agree with it, which normally means you think they're an employee and they want to disagree, then you have to have a dispute resolution procedure in place, which has some particular timescales. And then after all that, if you've determined that it's an employment arrangement, you then have to deduct PAYE and NIC from the 6th of April on payments to this individual's personal service company. So if you have not started that process by now, you need to catch up pretty quickly. Thankfully, HMRC have said that we'll have a light touch approach to this in the first year, which probably means it's code for they haven't got the staff to deal with it. I suspect they've got lots of other things with the coronavirus schemes, but you really need to get yourself on board with all that.
Just to remind, that's for non-small companies though, isn't it, Mike?
Yes, there is an exception for small companies, which is companies with less than 50 employees, less than 10.6 million euro turnover, is it 5.3 million gross assets? So you've got to have below 2 of those, I think.
Yeah.
So that's that. If you make VAT returns, you'll be aware of the Making Tax Digital arrangement, which was designed to actually make VAT reporting much more accurate. I have to say that I don't think there's any evidence that it's actually done that. But there are 2 changes coming up. For the 1st of April, you now have to have direct digital links between your software and the HMRC software. So hopefully your packages can cope with that. And Making Tax Digital at the moment excludes businesses that are VAT registered but are below the threshold. In other words, they're voluntary registered. From April next year, it'll apply to businesses of all sizes. And finally, a reminder, just because this is something we're doing a lot of at the moment, and Esther and I have become, well, very knowledgeable about it, is well, we won't call ourselves experts, but we know a lot about it, is we are talking to many clients and have actually carried through engagements where they're selling their businesses to employee ownership trusts. And all the ones I've done have been in the media sector, none outside the media sector at all. But broadly, if you want to exit your business and a third-party sale or a management buyout is not on the cards, you can actually sell your shares to a qualifying employee ownership trust. The trust has to have control of the company afterwards. But if you do that, you can have a complete tax deferral. In other words, you won't pay capital gains tax. Employees can have tax-free bonuses of £3,600 per annum, and there's some inheritance tax reliefs. Now, if you're not aware of that by now, and we've run webinars on it, so we've been shouting about it from the hilltops. It's something you might want to think about either now or in the future. And if you do come back to one of us, and we can tell you a lot more about it.
I mean, when we say deferral of capital gains tax, it's if you get the conditions right, it's 0% capital gains tax, isn't it, Mike?
It is.
And we are running, we haven't started promoting it yet, but we are running a webinar on that later this month. So look out for the date. I think it's going to be the 27th of March. So look out for that if you are interested.
Okay, and finally, what didn't happen in the budget? There was lots of speculation about increases to different taxes. Corporation tax was one of them, and obviously something's happened on that. But there was a lot of speculation about an increase in capital gains tax and or a reform of capital gains tax. Now, nothing was done about that. So entrepreneurs relief, as it's now called, business asset disposal relief, is still available. I wish I'd known about the lack of changes to capital gains tax last week, because I would have had a much more peaceful weekend, as we had quite a few clients looking to get deals through before midnight on Tuesday. But there you go, that's the way of the world. Certainly there's been speculation about changes to inheritance tax reliefs, and the other big area where there's plenty of scope for reform, and because most people accept that property taxes for businesses in this country is a bit of a mess. Now, none of those have actually been addressed, okay? But I expect that they will be addressed. And it would not surprise me if when there's some consultations being published on the 23rd of March, there will be some information there about potential changes that won't affect this year, but will in the future. And I would expect more announcements about this perhaps in the November budget. So I don't think those changes have actually gone away. They're still there. You need to sort of think about those, because I think other things are going to come down the track. And if you're going to, if you're going to reform a tax rather than increase a rate, it takes a lot more input and a thought process. Increasing a rate of corporation tax to 19 to 25% is relatively easy to do. Changing the basis of capital gains tax is more difficult. I suspect with capital gains tax, my favourite, and this is my view, not anybody else's, is we'll end up in a situation where short-term gains are taxed as income, but longer-term gains will be taxed at a lower rate. And certainly we had that sort of rule when Gordon Brown was Chancellor, because we had something called taper relief, which I thought made a lot of sense. If you make a quick buck on an asset, why shouldn't you pay income tax rates on it? On the other hand, if you're investing long term in a business, you should be able to pay capital gains tax at a lower rate. So I thought the taper relief was sensible, but obviously his successor, Alistair Darling, got rid of it. But there you go. So that would be my bet for the future, but obviously, who knows? Finally, I mean, the Chancellor mentioned several times that about the level of government debt, and we all know it's very high. And he said it's the largest level of government debt since World War II. And I thought I'd just end up with a nice cheerful comment at the end, is that the UK government paid off the last of its World War II debt on the 31st of December 2006. So it took 61 years to clear that. So I don't think anyone's expecting that we're going to put our sort of public finances right within the scope of this Parliament, or even the next one or the one after that. I suspect this is going to take a long time to recover. I thought I'd just throw that little anecdote in, not that it's that cheerful. So I hope you found that interesting and helpful. If there are any questions, Esther, can you ask me now? And we will circulate the slides to you all, or a link to the slides. I'm not quite sure how it works. And as I said, my email address is on the end there. So if you want to actually ask me anything offline, then you can come back to me.
Yeah, I mean, the other question was, are we expecting anything on the 23rd of March? But I think from what you've said, probably the answer to that is not particularly.
No, the basis, well, there are some documents to be published, and one of the things they said about none of those documents will affect anything that the Office of Budget Responsibility has opined on for this year. So I suspect it could be things that are in the pipeline for the following tax year, but it won't be any changes that will affect this year, because they said it won't affect any OBR sort of forecasts.
Great, thank you very much. Well, that is all the questions dealt with then. Apologies for the technical hiccup at the beginning, and apologies we've gone a little bit over time. Thank you all very much for coming. Like Mike said, if you've got any follow-up questions, do ask either your usual MKS partner or direct them at Mike. We have a great coronavirus hub on our website, which is full of really useful information of all the continuing government support, so please do take a look at that. And also we have a great Brexit hub on our website as well, so have a look at that. It's full of things, to do with international workforces, VAT, etc. So if you think those issues might affect you, then do take a look. So with that, I think I will say good afternoon and have a lovely weekend, everybody. Cheerio.
Cheers.